Alrighty, so in this video today, I'm going to be going over how to use algorithmic price delivery on the higher time frame and how you could have basically knew that today we were bullish and basically caught the exact bottom of these longs. So first things first, if you understand algorithmic price delivery, you know price delivers expansion, consolidation to another expansion, expansion to retracement to another expansion, and those are the only ways that price will deliver another expansion other than a reversal, but that's not important right now. So we know that for price to be delivering algorithmically, price expands, consolidates, and then expands again. So if you look here on this 1 hour time frame, 1 hour time frame, our first draw on liquidity is here, but our most important draws on liquidity are here because we have relatively equal highs. We have a high here and a high here, so we have relative equal highs. This high was created inside of the consolidation, so this is just minor liquidity. These are your external liquidity. So to start things off, you see we have an expansion higher, and then we have consolidation. What happens within consolidation? This consolidation is just accumulating orders, and I've shown most of you numerous times how to trade consolidation on a lower time frame. Is the exact same thing for the higher time frame. First thing you're going to want to do is identify your range. You see we have our range high and our range low here. Why is this the range high? Because we tested 1, 2, 3, 4, 5, 6 times. And why is this the range low here? Because we tested 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times here at the low. So your high and your low are confirmed. Once you've identified your range, the first thing, you're not going to want to take a trade until you identify this, a manipulation. We didn't get any manipulation in this leg lower. You're only looking for longs. If price delivers here short, you don't want to be participating in that because it's low probability. So you're only looking for longs. No manipulation within this leg. We have another expansion higher. Look at where we stop at, top of the range. Then what happens? The market makers show their hand. We get a manipulation. We take out this low, and we also leave a fair value gap, which is a CB, sell side imbalance. So once you have that CB, now step 2 of the consolidation model is a closure back above the equilibrium. What do we have here? These next 4 candles, closure right back above the equilibrium. So now price is showing me, okay, this is looking valid. Then what happens after we close above the equilibrium? Price retraces back down below the 50% and closes above the 50%, showing me that price is ready to deliver higher because we're starting to respect bullish order flow. So we tore through this bearish CB, which is now an IFVG once we get above. So we're disrespecting this bearish order flow, bearish PD array, and we're respecting the consequent encroachment, which is bullish order flow, a bullish PD array. So after we see that, the next step for the consolidation model is enter at or below the equilibrium. Now you are on the higher time frame, so unless you're entering on the 1 hour time frame, you could have taken this entry here. But what you're going to want to find is switch down to a lower time frame, and then you identify your entry. But we'll finish up this high time frame just in case you trade on the higher time frame. Manipulation has to have displacement. So we have a fair value gap here, has to have displacement. This is true manipulation. We inverse this gap. If you want to take a long on the 1 hour, you could have bottom tick this to the tick, the high of that gap, the high of this order block as well, or you could have used the high of the range. You see, even though price retraced back into this gap, into this consolidation range, we respected the high of the range and delivered higher to these relative equal highs here. And you see that's where price ended up stopping at. But we'll go down to the lower time frame and we'll break down how you could have entered on the 1 minute today. So I'm going to show you this, and you see here, this is where price retraced back into. You have to always remember that higher time frame. But we're going to do this really quick. Change that to blue. All right, so the blue line is the equilibrium of the entire range. The black line is the equilibrium of that CB, which is now at IFVG. So here it open. I'm going into the day with a bullish bias. This huge blue candle right here is our market open. So this is our market open here. I'm going into the day with a bullish bias. What I'm looking for is basically us to give me something in this area here, respect this order flow, and then continue higher. So if I was trading today, the first thing I see is this. Here's our first presented fair value gap. Now, if you don't know much about first presented fair value gap, I'll have to cover more about that another day. But this is basically your intraday bias. This is the market maker showing their hand. So here, price gives us our first presented fair value gap. And what happens? We respect the consequent encroachment of the entire 1 hour range. So here, we're bouncing off the consequent encroachment of that entire 1 hour range. This candle right here manipulates, creating us a long-term low, then displaces higher above that first presentation. Then you look in this first presentation and you see this wick fills this entire IFVG, which is first presentation, now IFVG. Why is that? So smart money can fill every single order in this area here. So the algorithm knows that smart money is looking to load up here because smart money knows where the market is going. Smart money is smart money. So this wicks all the way through here, fills every single order. Where my entry would have been if I was trading today would have been here at the high of the range, stop loss here at the lows, targeting your previous day high. Previous day high, that was 79 points, risking 21 points, easy 1 to 3 RR, 1 to 3.5 RR. That could have been a really simple trade. You see, after we inverted that gap, we literally got pure displacement. There was no pullback. Then you could have also called the shorts. So if you understand algorithmic price delivery, you understand price only moves in 4 stages. Here, once we take out this previous day high and we start to consolidate, that is accumulation, showing that smart money is accumulating opposing orders to fund either the reversal or the retracement. So here, we're accumulating opposing orders, bringing willing participants into the marketplace to short. If you ever take out a strong drawn liquidity, you never want to trade continuations through that. If we start consolidating, if you take out a drawn liquidity and you start consolidating, price is more likely going to reverse. So here, if I'm looking through this, I'm seeing, okay, we're accumulating now after taking out our previous day high. So what I'm looking for is to identify my range. Here we have the high of the range, and in all honesty, you could have used this as the high of the range or this is the high of the range. You see here, this has been tested multiple times. So if I was trading this, let's just say we came before this candle, this would be my high of the range here. So we've tested this 1, 2, 3, 4, 5, 6, 7 times, and then this would be my low of the range here. And you see we tested the low of the range 1, 2, 3, 4, 5, 6, 7, 8 times. So if I'm looking here, what's the first step before trading consolidation or accumulation? Manipulation. Leg higher. Do we have a manipulation? Yes, we have a manipulation. Do we have a fair value gap? No, the market makers are not showing their hand. We retrace lower. Do we have a manipulation? No, we don't take out the swing high. Retrace lower. Retrace lower. Do we have a manipulation? Yes, we do have a manipulation here. But why is this manipulation here not valid? Well, this manipulation here is valid, but why isn't this trade entry here valid? Because look at what happens. We manipulate with a gap, then what happens? We fail to close below the EQ. And I know a lot of you are going to say, but we did close above, just barely. This is, if you see a huge wick like that, for price to respect that, it has to close below the consequent encroachment. You see here, the consequent encroachment of this wick is here. This field, this whole lower half of this gap, failed to show any kind of displacement through the equilibrium. So here, look at this wick. This right here is basically showing me turtle soup, reacting out of an order block, showing me that we're respecting bearish bullish order flow. You do not want to short into a huge wick like this until you get a closure below the EQ. So this right here is a no trade because this is not a high probability previous candle. You see here, if you were to take this short here, you see we just barely closed below. Then let's say, well, we have no period near the equilibrium, maybe this order block, but we didn't even retrace back into that order block. So let's just say you want to use that order block there. Use this order block here. This next candle doesn't even retrace at all. It just continues straight down, heavy, and bounce all the way back up. That's not a candle you want to be trading against unless you close below the 50%. Market maker is always going to show you his hand. So here, no closure below the 50%, not taking that kind of trade against this kind of wick. Next thing we do, we go manipulate again. What happens here? We have a gap. Key to manipulation is a soup of a high and a gap. This gap right here is important because we took out this high. So we soup this high. What happens? We inverse this gap. We go one more time up. Then we go close back below. And whenever you see a candle closure engulf the previous candle and then that next candle close 50%, especially if it's against the narrative, that's a fake closure just to trap people that are going long here. So there's some retail traders, some traders that are seeing this and they're, oh man, we're bullish right now. We're bullish. We just inverse this fair value gap. We're going higher. And then what happens? Immediately we sell off. That's just the trap traders. You have to think like smart money. We're deep in the premium here. Smart money is not buying here. Smart money is selling here. We close back below. Price goes in here. Retest that fair value gap. We can't even close inside. Then we end up pouring lower. Get rid of that. Then what's the next step? Closure below the 50%. This is a nice closure below the 50%. You see in this whole leg here, we do create just a little baby swing high. But in this whole leg here, we don't create another predominant swing high. Like these swing highs here, they stand out. These swing highs are obvious. Here in this leg, there's no swing high until we close below. This is a nice closure because look at this candle wick. This is you're not having to fight the algorithm here. Here you're fighting the algorithm because the algorithm has to cover this much space before you can confirm this is bearish. Here, this is nothing to cover. Then what happens here? You want to enter above or at the equilibrium. So price comes, test this order block here, tap the consequent encroachment. We tap into the upper quadrant as well. But what happens? Price can't even close inside. If I was taking this trade, this isn't clean delivery, but I would have entered once I seen this candle failure to close inside of this order block. I would have taken this entry here. And then you see right after we close outside of that gap, we got displacement. And what happens? I tell y'all this a million times. Displacement out of the range, out of the range, out of the range, out of the range. And then what happens? We test the low end of the range to just about the tick. And then we continue lower. And where do we continue lower to? The market doesn't like inefficiencies. And look at exactly what happens. The market goes and fills every single inefficiency in this leg up. We balanced out this inefficiency, and what happens? Price is done going lower. So we balanced out this inefficiency, and price ends up, alrighty, we filled all the inefficiencies from today. This first presentation has been filled. This gap here, after we accumulated, has been filled. So now there are no more lower objectives, and you know your higher time frame is bullish towards those what? Those relative equal highs. So here, what happens after that? We fill this, expand, consolidate, and it's the same thing over and over and over again. I'll show you again. Consolidation model. All right, let's do this one. So here we have our low of the range, been tested numerous times, our high of the range, been tested numerous times. So if I'm trading the consolidation model, I am only looking for longs. And this also taps back into, this right here also taps back into that higher time frame, 1 minute IFVG. 1 hour IFVG. So here we tap into that 1 hour IFVG as well. So if you're trading a higher time frame and you understand market structure, you could have taken this long here from the absolute bottom. But here we have an expansion higher. We're only looking for shorts because what happens? Expansion, consolidation, expansion. Price is never going to expand, consolidate, and then reverse. If it only can do that after we've taken out important liquidity. So here, expansion, consolidation, expansion. So here we have our low of the range, expansion. I'm looking for a manipulation on the leg down. No manipulation, fair value gap, but no manipulation. So I'm not counting it. Here we have a low. fair value gap, manipulation. Then here we have a closure above. So this is a valid manipulation. This is the market showing their hands here. So here, let's just say if you were to take this trade after we inverse this gap, you would have taken a loss, but you can't be 100%. But after you take a loss, the biggest thing is you can't win every single trade and you have to remain mentally disciplined. What happens here? We have another manipulation. What does this manipulation here offer? A fair value gap after we swap out the lows. We swap out this low and this low. So now we have another manipulation leg. What am I looking for after that manipulation leg? Looking for a closure back above the EQ. What do we have? A closure back above the EQ. We also have this manipulation fair value gap here. What happens when price taps back into this manipulation fair value gap? And I said this for the first entry on the higher time frame, this accumulation entry, and I'll say it again. You want to enter at or below the EQ. So here we have our fair value gap, our CB. We're entering at the high of the CB, stop loss below the low, because why? This is higher resistance liquidity. It is going to be harder for price to take out this low. So you're expecting another swing low to be formed on the right side. So this can be your protected low. So you have your protected low here. And then what do we have to the buy side? Lower high, lower high, lower high, lower high, lower high. Tons of low resistance liquidity, easy targets for price to take out. So this is what you want to be trading towards. So here we manipulate that low, closure back above, tap into that PD array. This is our first important PD array because this is the fair value gap that created the manipulation. We tap into that PD array, displaced up out of there, came and visited that PD array again. I would have averaged in here because if you see here, the candle wicks can't even get past the upper quadrant of this gap. So the buyers are staying out. Candle wick can't even get past the upper quadrant, showing strength to the buy side. Then you see we displace out again, then a little teeny tiny consolidation model, and basically that's all she wrote until these highs. And you see previous day, these equal highs were tapped just about to the tick, and then price kind of died off.